Hey, this is Sasha, and welcome to another episode of Let's Talk Stocks, episode number 189. Now, in today's lesson, what we're going to do is focus on Iron Condor portfolio building. So we're going to look at building out a portfolio using Iron Condors. Now, we're doing this in conjunction with the course that we have coming out very soon, the Options Mastery Iron Condors course. That will be set to release in July. It will be open for a handful of weeks. And then it'll be closed down to get feedback and see if there's any additional content and material that we need to add to that course. So if you want the early bird special, make sure you get on the newsletter list at the end of this video by clicking the button over there on the top left that'll come up, or visit the page, the link below this video, and go to our website and get on that newsletter list. That way you can get notified when this course is released here in July, along with the early bird special that we'll have running on this course and promotion, which we don't really do that often because it takes a lot of time to do the promotions, to lower the price, raise the price, back and forth. So in either case, get on the newsletter list if you want to get notified, and we have more news about it coming out very soon. Now, today, what I want to do is really look at building a portfolio with Iron Condors. I want to show you the power behind it. I want to show you the capital, the margin requirements for it, and why you can do really well with Iron Condors when it comes to building out a portfolio, because it's not like a stock where you buy a stock and a stock goes up. And then if it stands still, you don't make anything, but you need that stock to head higher. With Iron Condors, you don't really need that. And I'll show you what really a portfolio looks like, because most people, they don't even understand a portfolio, what it means, not to mention how to really build one and construct one. Now, we'll do it in a simple version here, kind of really compressed and condensed for a YouTube audience. But if you want to go deeper into it, we'll go more into those through our courses, and you'll get to learn more about that as we get into the Options Mastery course series. So take a look at those along with the vertical course that we have available if you're brand new to trading options. With that being said, let's take a look at building out a portfolio. So a portfolio is really a basket of stocks or a basket of positions. In case one position gets in trouble, you have other positions that kind of work together to help save you or not lose as badly. Now, if you didn't watch our previous kind of basics of Iron Condors, you may want to watch that previous episode. I believe it's episode number 188. So a basic construction of an Iron Condor. And when we look at a basic construction, we'll just do it with Apple here. What you're really doing is selling two vertical spreads. And I'll show you how to do this here with Apple. So when we look at Apple, let's say I go out about 60 days in time, and I'll sell a vertical spread here at, let's say 155 and 150. So let's say 155, we'll sell a vertical. Okay, I'll analyze that trade. And then you can see the white line here is the current line, or today, and the green line is at expiration. So here on this chart, what we really have is our price down here below. So right now the stock price is at 185, and here's your profit and loss with the zero line being right here. So basically, as long as that stock stands somewhere between 155 or higher, you make at expiration $19. Now, that's not too bad, but remember, you're only using $481 of capital. So on on about $1,000, you're making about 38. So it's pretty good percentage-wise within 60 days. So imagine just turning that every 30 to 60 days. So as we construct the next part of this, we want to do the same thing on the call side, okay? Because right now we're selling on the put side, and now we make money if the stock stands still, because with time, we make this theta, because premium expires with time, just like your car insurance premium expires, and then every month you have to buy more insurance. And this is what you're doing. You're selling insurance on stocks. So you make about $1.06 here every single day that stock stands still or doesn't move. And with time, you can see that theta actually will continue to kind of accelerate and then decelerate, because with time, theta continues to pick up because there's less time premium towards the end. Basically, these become worthless the last couple of weeks there. So what we'll do is we'll construct the other side now, because here, if stock stands still, you make money. Stock goes up, you make money. Stock goes down a little bit, well, really 20, 25 points, you still make money at expiration. But if it goes down a lot, you lose about $1,000 on that investment. So the way you kind of protect this is, let's say you go ahead and sell about the 210, maybe a little bit higher. So we'll sell a vertical over here on this side, 210, 215. And now we'll do 2 contracts here. And you can see I've kind of closed this off. And now, as long as that stock stays in that range, I make money. So how much do I make? Well, I make about $94 on about $900 of investment. So why did this 900 go down from about, what was it before, 960? Well, it's because the other side makes you some money. A stock can't be in 2 places at once. So they only take one side of that margin. So you're making about 10% on your money in how many days? About 60 days, 10% on your money, right? $96 on about $1,000, $900 to make 96. So that's pretty good odds, right? Now you're looking at it where you basically need to pick a range. It's not that you need to pick a stock that goes up in a direction, you just need to pick a range. And here you're looking at 155 to 210. So the key question is can you choose a range for Apple? Let's just pull up a chart here. If we look at Apple, can you pick a range for this stock? And you can see the range that we have. Okay, so here's the current stock, here's the price. And we look at this, we got 155 to about 210. So do you think that stock will go between 155 and 210? That's a pretty big range, right? To make 10%. So as long as it kind of hangs out here in the next 60 days or even up here, it's fine, or even sideways, you're good to go. Okay, now can you make this a little more bullish if you think this stock is going to pull back? Absolutely. Can you make it more bearish? Absolutely. So how do you do that? Well, let's say stock prices are heading higher and I want to tweak this a little. Well, I could sell more on the put side. So I'll sell maybe 3 or 4 over here. So I've stacked more risk on this side. Okay, a little less risk on the upside, but now I have a bigger delta. And this is what this delta really means, is that the more you're stacking on here, it's basically the price change or your price risk. So for every $1 that stock moves up, you make $1. Now keep in mind, you make theta as well and vega as volatility decreases. But take a look, as I start stacking more and more contracts, let's say I stack 20 contracts here on the put side, for every $1 that stock goes up, I make $32 because we're so weighted here on the put side, which basically means we need that stock to go up. So this is what you can do, is you can skew this position kind of any way you really want. And if you feel like, well, I believe this stock will go up with time, well, you could go ahead and do a 5 to 2 kind of position, meaning you have 3 deltas, you have 3 to 4 thetas, and you have a negative 18 vega. So overall, you're still kind of bullish on this position. And with time, that white line will get closer to your green line or expiration line. And then what you can do is take this position off early if you like, or wait until it expires, as long as you're kind of in the safe zone. Now, there's a tricky kind of part behind managing it and adjusting it, which we go over in the course. But let me show you now how to build a portfolio and what the portfolio looks like. So let's say I go ahead and set up this Iron Condor. Now you could do it all at once or do it in verticals like I've done it here. So I'll go ahead and stack, let's just do 6 contracts to 4, be a little more bullish on it. I'll go ahead and confirm and send these orders. Now this is a paper trading account, so just to show you for example purposes what the portfolio is going to look like here in a bit. But once we get filled here on this, I'm going to show you how this all works together, because we need multiple positions to kind of build out our portfolio. Okay, so I have one that's kind of a little more neutral, little bullish position, right? The next one, let's say you have a couple other stocks you want to trade, or you have some things in mind. And I'll go ahead and look at McDonald's. And here's McDonald's as we pull up a chart. This one is starting to break this upward trending line. So you can see we've had a major downward bar, possibly an ABCD pattern. So we could say this one might get into lower prices, and it's acting kind of weak. So we can do the same thing with McDonald's, but do it a little more bearish. Okay, so again, what I'll do is I'll do it now. I'll sell an unbalanced Let's see if it'll let me do that here. Sell an unbalanced Iron Condor, okay? Analyze the trade, and now what I can do is kind of manipulate my strike prices here. So let me get rid of these slices so you're not confused. The current price is 159.84, basically around 160 here. So that's the current price. So I want to hug this or surround this. So we have our calls. We'll probably need to bring those in. And where will we bring those in? Probably about 170, 175. Okay. So 170, 175 will be the call side. And the put side will need to go under that, probably about 130, 135. Okay, so we'll drop these down quite a bit. Let's say about 135. And this will be about 140. Okay, so now you can see I've set up this Iron Condor right here. Now it's still a little bullish because remember we have more weight on the left side or the put side. But what I could do is stack more weight on the call side because you're looking at this as a bearish position. So what I'll do is take a look at this. I'm basically stacking about $755 of risk on the left or the put side, or about $1,200 on the call side. Now to potentially make 246. If you do a good percentage on that, that's a pretty good percentage. And again, this is about 60 days out. So I could go ahead, if I'm a little concerned about the upside, you know, I could move these out a little bit, but I think we're okay. Let's just play it here by ear and stack a little bit more contracts because this one is, let's say not as large as Apple. So I'll need to stack a little more contracts here. Let's just do, again, kind of 6 and 4 on a bearish note, or we could do kind of 6 and 5. We don't have to make it too strong because remember, you're short Vega here. It's a little more complicated beyond the scope of this video. Really, you'll want to take a look at the course to learn more about these Greeks. But what's going to end up happening here is that if volatility increases, okay, this white line will drop a little bit because we have a Vega risk problem here. So we want to always be a little short delta to be a little more neutral. So definitely you'll want to keep an eye on that. So you'll play with it. Let's say we'll go with 6 and 4. So I'll go ahead and put this position in, and just to show you how this all plays out. So now we've done one kind of bullish and one a little more bearish position. And let's say I do one that's a little more neutral. We'll put on Caterpillar. I'll go ahead and sell an Iron Condor. We'll make this one a little bit quicker since you've gone through the process. Caterpillar currently is, delete some of these slices, 141.03. So on the call side, when I look at this, I'll probably want to be around 160, 165. Okay, so we'll move this to 160, 165. Okay, and the put side probably about 120. Yeah, that's about where it is. Maybe 115, 110. Let's say 110, 115, just in case prices continue to sell off. And now again, start stacking some of these contracts. Let's say we go with 4 or 5 contracts right here. Okay, if you want to go a little wider on one, you could say, hey, I'll do the spreads a little different. Let's say 10 points on one and 5 points on the other. You could do that. I'll keep it kind of a little more balanced here, but I'll bring in the call side just a little bit. And we'll do something like that just to have a little extra negative delta there. And again, 5 contracts. Put that in. Go ahead, see if we can get that order filled. I'll try to make sure we get it filled pretty quick, just so you can see. Okay, and there we go. So we got that order filled. So now what you can see is we have these positions. We have a Caterpillar, we have an Apple, and we have a McDonald's. So you can see they're all skewed a little bit different. McDonald's is already up $2.71. Apple is down about $10, and Caterpillar here, we just placed it on, down about $10. Again, bid-ask spread, it takes a little bit of time. Let's say we move this 3 or 4 days forward. okay? So time value just decays. So now what you can do is take a look at this position beta weighted on Caterpillar. So again, we're going to keep all the Caterpillar prices here on our chart, but now we'll go, instead of single symbol right here, looking at things on a single symbol view, we'll take a look at things in a portfolio view. So what this does now is, and let's just hide any simulations. What this does is now averages all these positions together and kind of composites it based on the Caterpillar price. So you can see I have Apple in here, Caterpillar, and McDonald's, and there's all my positions. And as I look at this spread, it now gives me an overall picture, and you can see perspective here of this expiration curve and how we're positioned. So you can see within a few days, we're still going to be about negative 48 delta. We're going to be about positive 21 theta. We've got a negative 102 vega. And we'll be up about $47 if prices kind of hold stable. Now, if prices go down a bit, well, what's going to happen? Well, take a look at Apple. Apple will be down about $60, $80. Caterpillar will be up about $80. And McDonald's will be up about $156. So overall, we'll still be up about $150. But you can see one position doesn't hurt you as much when it goes into trouble. Like Apple here would be in a little trouble because we're bullish on that position. And this is what a portfolio really does, is it allows you to spread and mix the risk around depending on where stock prices go, because you don't really know where the prices go. And that's why trading Iron Condors can be very beneficial. As you can see now, I can overlay 2, 3 positions, 4 positions. I can make them a little bullish. I can make them a little bearish. I can be a little neutral. And now you have this portfolio basis that if things get in trouble, watch how I can flip on this on a dime. So let's say things are moving against me. I can hedge this position based on the cues. So let's say I buy this and prices start heading higher. Let's say we show everything. Let me get rid of some of these other simulated positions that we have. And now what we can do is skew this. Let's say I go with 20 shares here. So you can see if prices started to move up on me pretty quickly, let's say we are right here now, but prices start heading higher, well, what can you do? Well, here's what you can do. You can go ahead and hedge this by just getting, let's say, the Qs, 20 shares of that. Now you could do 50 shares if you're looking for a faster movement. And now you're adjusting your portfolio. And this is really what a portfolio is. This is what it does. So keep in mind now, okay, now you have 50 shares of QQQ, which is a little more tech heavy, but you're also still getting and collecting that theta premium. Every day you're getting theta, theta, theta. And this is the beauty and the power of trading Iron Condors, because now you can continue to stack. You're stacking more and more of that theta, the time value. And what you'll see happens here as time moves forward, okay, so let's say right now we'd make about $20 every single day. As time moves forward, you can see that starts to pick up to $25, to $30, little by little, because you're getting closer and closer to expiration. And as you start trading with larger account sizes and capital, let's say you go ahead and we analyze a duplicate trade of this, okay? So now, okay, you can be starting with 25 theta. As you pick up contracts, 28 theta, 35 theta, 40 theta, $50 every single day if that stock stands still. This is how the big boys make a lot of money, okay, with less capital, right? Because for you to be able to make, let's say, $2,400 right here, here's $2,400 in 60 days, it requires about $18,000, $19,000 here on this capital side. So think about it, $2,500 on $18,000. Look at the percentages, okay? So if we take a look at percentages, right? So let's take out a calculator here. So what is it? 2,432 on about $18,500. You're making about 13% in 60 days. Pretty good return on investment. Now you're not going to make money every single month, But as you manage and budget some of these positions, because some of these will lose out, as you know, others will make money because they're not going to land and sit still. You might end up over here. So you might close, let's say, one of the losing ones, but you got the 2 and 3 other ones that'll be okay. And that's the way money is made in this business, in Iron Condors, in stocks. This is how the big boys make money. This is what I wanted to share with you on a portfolio beta weighted basis. Of course, you can overlay calendars on this and many other strategies, diagonals, verticals, combining it to make a portfolio, but we'll get more on that later. So anyways, thank you so much for joining me. I wanted to share this concept with you as far as Iron Condor goes, because it's important to understand what a portfolio is, how it works, how it operates, and to show you how things work in the marketplace. Now, if you want to join me on my Iron Condor course, and when it's released, you want to get notified, get on the newsletter list right here, because that's where I send you all the details about the release dates, pricings. I'm going to even share with you some special videos behind the scenes in terms of what's in the folders, the videos, and just show you the depth of content that we're going to get into. So stay tuned, get on the newsletter list if you want to be notified of that, or of course, join me on YouTube by hitting the subscribe button right here. Thanks again, and remember, do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.